We have Neil Wolfson from BorrowersFirst. BorrowersFirst is a new fintech entrant, and today it actually announced it has secured equity and debt funding from SF Capital Group, a firm known for its successful fintech investments. Pave, if you're in the room, come over to the tech man over there, and let's welcome Neil.
Thank you. All right, let me go through and tell you a little bit about BorrowersFirst. But before I do that, let me take a step back. I'm with SF Capital, and we just funded BorrowersFirst. And BorrowersFirst is launching within 30 to 60 days. And the reason we invested, we took a look at the industry, took a look at who was in the business, who was getting into the business, who was thinking about getting into the business. And we did a pretty comprehensive study of it about a year ago. And we identified BorrowersFirst as the firm that we wanted to work with. And the first reason is the strength of the team. They have an average of 20 years of experience. In fact, everyone in the senior management team has over 20 years of experience. So I'm talking about Chief Technology Officer, Chief Risk Officer, General Counsel, Chief Marketing Officer, Director of Operations, all have north of 20 years experience in this area. They've done it before. They've launched successfully. So that was the first reason. Second reason, different business model. We're entering the space and competing against LendIt Club and Prosper. And you all saw their presentations before this. And you saw Renaud get up and give the industry statistics of how successful they've been, and it's been amazing. So we could create a sort of Me Too product and go after the exact same market they're going after in exactly the same manner. Or we could create something that's a little bit different. And we opted for a little bit different. So we're going after similar FICO bands. We're going a little bit below their FICO range. We're starting at 600. We think the near prime space is something that is ripe for garnering loans right now. You can market into a strategy where there isn't much access to credit. There's a tremendous need for credit. There's not that much access. So we think going slightly below their FICO bands, as well as through their FICO bands, gives us a competitive advantage. But something that I think is really powerful in this, balance sheet capital. So I know the whole industry is peer-to-peer, and you've heard Renaud use the term marketplace now, and it's gone through different iterations, the euphemism of the month club. But basically, because it really isn't peer-to-peer. I mean, let's face it, it's not an individual doing a loan to another individual. It started out some of that. But it's largely institutions who dominate the marketplace doing loans. So they've changed and they've called it marketplace. But it's still selling to somebody else. And one of the knocks on the industry that I've heard so often is that they're basically selling off risk, which is tremendous for their shareholders and the valuation of their company, but not necessarily for the people who are investing in it, because they're the ones bearing that risk. So basically, companies get paid no matter what happens to the loan, and they're not sort of eating their own cooking. They're not on the same side of the table with those who are buying the loans. So we wanted to create something different. Yes, we are selling off loans. And yes, we are offering those loans for sale to large institutions, family offices, and the like in whole loan fashion. But we are also keeping a portion of those loans on our balance sheet. So in other words, what people don't necessarily want because they don't have an appetite that particular period, we're bringing them onto our balance sheet. So what it enables us to do is basically have so much confidence in our model, we're able to market that we believe that our underwriting is so superior that we're willing to accept any loan that makes it through our underwriting model. And why shouldn't we? Why should we pass the risk off to others and not be willing to accept it on our own? But it also offers a bunch of other benefits. Certainty of funding. You heard the conversation about speed. Ron Suber just spoke about how it's streamlined, but it used to take a really long time to fund loans. And now it's down to 4 days or whatever it is if the loan gets funded. It used to be a lot longer than that. It used to be weeks. And you don't have to take weeks when you know you're going to fund the loan. In fact, if it gets through our underwriting model, it's guaranteed. We'll take it, or we'll sell it to someone else. And actually, in the reverse order, we'll sell it to somebody else, and then we'll take it if, in fact, they don't want it. So speed of funding and certainty of funding go hand in hand and are a tremendous differentiator. We have an ability to branch out into other areas. We can do loans for employees of companies. So a company can offer an employee benefit that's loans to their rank and file employees. We can do that because we can put it on our balance sheet if it can't be sold off. When you go into a new area, the first thing everybody's going to say is, give me the static pool history, how long a track record, let me analyze the data ad infinitum. We can say, we've done that analysis internally, we're comfortable with it. If you're not comfortable buying it, we'll buy it first, we'll season it, we'll own it for some period of time, we'll keep originating, and then when you are comfortable, when there is enough data, you can in fact go and take advantage of that. So I think that's another tremendous advantage of that. And then the other thing is it really puts us on the same side with the investors. I mean, again, we're on their side of the table, and we're able to do things that I think others aren't able to do. And finally, it's going to be more revenue for us. I mean, one of the advantages, the reason you're buying the loan is you love it as an asset class. We love it as an asset class too, and we should be willing to buy it and keep it on our balance sheet. What that means is if the loan's averaging 15%, rather than getting that upfront fee of whatever 5%, we're able to get 15% per year. So obviously have much higher revenue on that. Just as you like those loans, we like those loans. And again, I think it's something that truly differentiates us from others, having both balance sheet capital as well as being able to sell off whole loans. And I think it places us in a different position. And again, we're very excited about it. There's a press release. If any of you don't have it, we have copies of it that just went out today. Peter Renton devoted Lending Academy article to Borrowers First today. And there's also a 2-page sheet which really shows a lot of this information and what we're doing and how to contact us. So again, thank you very much.